Welcome to Retirement Revealed. I'm your host, Jeremy Keil, and we're here to turn your retirement savings into retirement income. Today, we're talking about life insurance retirement plans and whether you should be using one. This started a bit because I was asked to provide some quotes to an article about life insurance retirement plans through medium.com. Through that, I got, I wouldn't say introduced, but more aware, and I started looking into more the Becoming Your Own Banker book by Nelson Nash. And of course, you look for things online, and all of a sudden all your ads and your social media feeds start popping through with those types of things. And it's amazing how many people are talking about life insurance retirement plans as a way to save, as an alternative. Looks like online they're not even talking about it as an alternative, like just do this only and not save into things like the Roth IRA, the 401k. So I want to talk about a life insurance retirement plan. Should you use it for retirement planning? And there's a few things that come in mind. One is I'll talk about what's going on today. You're on TikTok, Facebook, and LinkedIn, and a lot of people are talking about these index universal life insurance policies and other ways that you can save into the stock market, but without the losses that you may receive in the stock market. And these indexed universal contracts or indexed annuities that might be out there, they'll say you get market-like returns or participate in the stock market without losing on the downside. What's interesting about those specifically is, yes, your interest might come in based on you're getting a credit, an interest rate based on what happened with the stock market. But if you're actually comparing them to the stock market, there's a lot of research being done that has been done on the years upon years that indexed annuities have been out there, and the returns don't match the stock market. They're a lot closer to the bond market. And the reason why, I think, is that when you invest in a insurance policy, when you buy an index type of account or just any insurance, the insurance company they're going out and they're buying bonds with your money. So it's hard to get an interest rate, hard to get interest credit gains that are more than what bonds are doing. That's what the research is showing, is that these index universal lives, that whole life cash value, these types of accounts are more as an alternative to bonds or CDs or your bank account, because that's basically what's going on in the back end with the insurance companies. They are investing in bonds. So the idea that you get market-like returns, as in you do exactly as well as you could do in the stock market, the research is not bearing that out. Now then, the question is, should you use life insurance for your retirement plan? You ought to consider it as an option as part of your retirement plan, just like you should consider everything as an option as part of your retirement plan. The danger, what's happening with a lot of these things you see with life insurance retirement plans or be your own banker, infinite banking, is that it seems to be approached as this is the only way to go about it. It's maybe something to consider, but it's definitely not the only way to go about it. There's a lot of advantages to Roth IRAs, 401ks, savings accounts, brokerage accounts, and the answer to just about any financial question is not the one thing. It's how do you put a lot of things together. So I'm going to talk through here the life insurance retirement plan, especially around the idea of this becoming your own banker, Nelson Nash, infinite banking concept. What's interesting, reading through it, and Nelson talks about the power of dividend-paying whole life insurance from a mutual insurance company. And he says the goal is to recapture the interest that you are paying to banks and finance companies. So what they're saying, what he's basically saying is, don't pay the interest to a bank, pay the interest to yourself, which is interesting because when you are someone that has a whole life insurance policy and you take money out, it's really not much different than taking money out of your bank account, right? You have 20 grand in the bank, or you have 20 grand in whole life insurance, you take 10 grand out, your cash value, your bank account value drops by 10 grand. There's not much difference there. Somewhere in the book, around page 70, he talks about how when you pay interest to the life insurance policy, you're paying interest to yourself. That's not the case. You are paying interest to the insurance company as opposed to interest to the bank. What's so interesting about his concept of infinite banking, it was born, he says, born in 1980, when he owed about $500,000 on different real estate loans at 23% interest, and he realized he could borrow at 5 to 8% on his life insurance policies. I believe that was the case because interest rates back in 1980 were 23% for a lot of different areas. And an interesting thing about life insurance policy, he talks about some specifically bought in the 50s, is these insurance policies, you could borrow money out of them, and yes, the interest rates were at 8% at the time, and the real estate loans for him were 23%. Yeah, you're way better off borrowing from the thing that's at 8% compared to the thing that's at 23%, but I'm not sure if that really works out today. I'm looking here, and of course, 2024, the interest rates have spiked, but you look back through 2008, interest rates were much lower than they are now, certainly not the 8% you could borrow from an insurance policy on there. Right now, today, I looked, these are all basically August 1 of 2024 when I looked here. Average personal loan rate is 12%. Okay, so that's not 23, but it's above the 8% that you could maybe borrow from your life insurance. Average auto loan rate, 8%, 8.65. Average mortgage rate 6.75%. So here's Nelson Nash creating this concept, infinite banking, that a lot of people base the idea of life insurance retirement plans around. And with that, he made all these assumptions based on 23% interest. Well, that's not the case right now. You look at a mortgage, he had a 23% mortgage rate, and he borrowed instead from a life insurance policy at 8%. That's a great move. Good for him. Back in 1980, your average mortgage rate below 7%, and you might be able to get a tax deduction on it compared to the average life insurance rate that he uses. And I'm looking at some real life examples. Won't show you them because it's all connected to clients. Obviously, I'm not going to show you that kind of stuff, but I'm looking at real life examples. Yeah, 8%. Looks like the average rate you could pay on borrowing money from your life insurance. So why would you pay 8% to your life insurance company when you could pay less than 7% to the mortgage company, and perhaps you're going to get a tax deduction on that? What's good, and I think you ought to read this book, Become Your Own Banker. It's got some interesting things on there. I think he's got some ideas that are very true. It's very true that whole life insurance from a mutual insurance company that pays dividends is a way to put extra money aside, and you can grow that tax deferred. But I think, like I started, you ought to compare that to bond type investments, compare it to CD or saving types of investments. And what he points out, and I'm glad he points this out because I don't really see this in all the TikTok videos that I see and LinkedIn videos, where it takes about 7 years. If you want to start today and you actually properly structured it and kind of followed Nelson's concepts, it would take you about 7 years to break even. The idea that you put money in to the life insurance policy and you're kind of losing money for about 7 years before you break even. If you're trying to think of things like a get-rich-quick scheme, and he very much says this is not a get-rich-quick scheme. It requires long-range planning because it takes 7 years or perhaps longer to actually break even when you are adding money into the account. So when you're being approached by someone that says, oh, life insurance retirement planning, that's the way to go. Ask them, well, how long does it take to break even? Ask them, what's your commission, right? Because they're selling you a life insurance policy. They're going to make commission on there. Other parts of it too, and I'm looking through the different, he goes through, put some spreadsheets in there of, okay, here's how it might work. And I'm wondering if this is how it maybe worked back in 1980, maybe how it worked in 2000, but here it is 2024, and a lot of his assumptions that are in here, his assumptions show that CDs get 4.5%, but the life insurance gets 6 to 8%. I'm looking at, I looked at several policies. I'm looking all around. I cannot find life insurance that's paying out at 6 to 8% cash on cash, where you actually see, okay, you had $100,000 today, and a year later, without putting any extra money into it, you get 6 to 8 percentage points on top of that. I see roughly 4.5%, basically matching what the CDs are in his example. And of course, if you assume CDs make 4 and life insurance makes 6 to 8 above all the costs, yeah, the insurance is going to work out. But that's not the assumption. Maybe that was the case back in 2000. That was his last update here. It was actually 2008. Interesting enough, right before the, or maybe during the great financial crisis. Yep, 2008, the 5th edition, 2000 for the copyright on there. But you look at it today, 2024, think of, all right, could I get 4.5% on a CD? Just about. All right, could I get 4.5% on life insurance? That seems like that's a number that you could get. But you're making the 4.5 on the CD for years upon years before you break even on the life insurance. And then all you're doing is breaking even on the life insurance compared to the CD. 4.5 versus 4.5 perhaps is it's the same number. You're not getting anything extra on it. But what's interesting, that 4.5% on a CD, you do pay taxes on it. In the life insurance, it's tax deferred. That growth, that interest is tax deferred. You don't pay taxes on it until later on. And then if you set up your policy where it is not a modified endowment, something that's a tax qualification, then when you take money out, you can take the principal out first, leaving the interest inside the life insurance policy. When you pass away, that interest that you never pay taxes on becomes tax-free as a death benefit to your beneficiaries. I think that's the idea behind the infinite banking concept of perhaps you do this and then your generations on down the line are buying the life insurance and using it to finance businesses, finance your houses and so forth. So if you're interested in infinite banking, I'd probably trust Nelson a little bit more than what you see on TikTok, Facebook, and LinkedIn ads because he is talking about the long-term nature about it. He is giving advice. His suggestion is you buy dividend-paying whole life insurance. You find a mutual type life insurance company. You buy the lowest amount of life insurance with the highest amount of premium you can put in, so you're getting the most in the growth part of it. Those are more sound than what seems to be a get-rich-quick scheme I'm seeing on LinkedIn and all the other social media things that are out there. So as you're going through, whether you are thinking of life insurance, Roth IRAs, a particular stock, remember that the solution to most financial questions is not what's the one thing that does all things. It's how do you put a lot of things together. You want to have a process when you are planning out your retirement. That's why we've got the 5-step retirement process. You can go to 5-step retirement plan to learn more about how you go about things in a specific order to focus on lowering your taxes, increasing your income, avoiding big retirement mistakes. I think the solution to a lot of financial questions is what is the process you use? How do you make good decisions? And not as what is the product. Be aware of someone that says this is the one product that does the best thing. Here's the product that you use. When you hear product, think of sales, think of commissions. So the idea of life insurance and retirement plan, I'm going to link to the, in the show notes, I'll link to the Become Your Own Banker book. I'll link to the article that was written on medium.com about should you use a life insurance retirement plan. I think a better way to look at it is should you use life insurance as part of your retirement plan? And you might want to have life insurance as part of your retirement planning because you might have a pension or you might have salary or you might have your loss of Social Security where you are no longer here and someone that relies on you is not getting that income anymore. So perhaps you want to have life insurance still in retirement. That is A-OK. It's if you are wanting to protect someone from a loss of income, life insurance is the way to do it. And as you have the life insurance, if you want to put additional money into it to bring along some gains, some interest, some dividends that are in there, I think that's A-OK as well. But keep in mind, I believe it's an alternative to bonds. It's an alternative to CDs. It is not an alternative to the stock market. Keep in mind, it takes 7 years to break even. You put money into Roth IRA, you put money into the 401k, there's generally no huge commission that comes out of it, like there is a big commission with whole life or any type of cash value life insurance specifically. So consider the risk, and when someone says, oh yeah, use the life insurance retirement plan, think of, should I use this as part of my life insurance, as part of my retirement planning? It is not the only part of the plan. Thank you for listening to Retirement Revealed. We believe if you know more about your money, you'll feel better about your money and you'll make better money decisions. Hi, I'm Jeremy Keil, owner of Keil Financial Partners. And if you're interested in seeing how we help our clients get more income, pay less in taxes, and avoid big retirement mistakes, make sure to go to keilfp.com. That's KEILFP.com.